Good afternoon and thank you for joining us at Future of Finance. Today, the message from CBDCs to payments banks is innovate or die. This is the third in our series on CBDCs. I shall now hand you over to Dominic, Hobson and the panel. Thank you.
Hello everybody and welcome to our webinar. The message from CBDCs to payment banks is innovate or die. I'm Dominic Hobson, co-founder of Future of Finance, and I'm delighted to moderate our discussion this afternoon. Now, more than 50 central banks are now doing something, even if it's not very much, about a CBDC. The Central Bank for Central Banks, the Bank for International Settlements, has said CBDCs are an idea whose time has come, and that it's now only a matter of time before a major economy launches a CBDC. Two CBDCs have actually launched already, and the one unequivocal lesson that they impart is that each CBDC is going to be different because every country has different needs and different motivations. But any CBDC will have an impact on domestic payment systems, and all those different CBDCs will still have to be exchanged one way or another across national borders. In fact, in all the excitement about what transactions a CBDC will make possible, what innovations it will spawn, and how it can be programmed, it's very easy to forget that a CBDC is, in the final analysis, a payment instrument that is the same as physical cash, at present the only form of central bank money which ordinary mortals like us can enjoy. But how we pay is actually a lot more important than what we pay with. And it's in potentially changing how we pay that CBDCs raise extremely profound questions about the entire structure of our domestic and global financial systems, about public policy, about civil liberty, personal privacy, and commercial confidentiality, and about the nature of innovation. To discuss these and other vital issues, I'm joined by four people who wrestle with them in their different ways every day of their working lives. Will Lovell is Head of Future Technology at the Bank of England, a role in which he looks at how new technologies of all kinds, not just blockchain and AI, but conventional technologies as well, can help the central bank fulfill its mandate to keep prices and financial institutions stable and enable consumers and companies to pay for things easily and securely. His particular focus is payment and settlement platforms. Cunha is a senior vice president at the Federal Reserve Bank of Boston, who has concentrated for much of his career on payments, and especially payments technology, innovation, security, and fraud prevention. He's now applied his long experience to research into CBDCs and is using, in his study of that topic, his long expertise in payments and payments technologies. Simon Gleeson is a partner at Clifford, specializing in banking and financial markets, an advisor to governments and regulators as well as banks, a global leader in the development of law and policy in finance, and author of the excellent book, The Legal Concept of Money. Ricardo Correia is the managing director and global head of CBDC and digital currencies at R3, which he joined 5 years ago from Commonwealth Bank in Australia, where he was co-head of emerging technologies. R3 is working with a number of central banks on CBDC projects. In addition to our full panelists, we do also, of course, have you, our audience, and all five of us encourage everybody watching or listening to submit questions and comments throughout this webinar by using the Q&A or chat functionality at the bottom of your screens. We will not be saving them up to the end, but we will answer them as we go along. I'd like to kick our discussion off by asking whether the long-running distinction between a wholesale CBDC and a retail or general purpose, as it's sometimes called, CBDC, has now been resolved. In a long essay in its 2021 annual report, the Bank for International Settlements came down pretty unequivocally in favor of a two-tier system in which central banks provide the infrastructural services, that's to say the issuance, the liquidity, the settlement finality, the operational resilience, and the cybersecurity for CBDC, leaving the private sector, commercial banks, and possibly other private sector firms to provide the customer-facing applications, the digital wallets, to run the KYC, AML, CFT, sanction screening checks, and of course to provide the payments apps. Previously we'd talked, and this is I think our third CBDC discussion, we had discussed wholesale versus retail versus hybrid or some combination of these. Now my question, and I'd like to throw this first at Jim, is how realistic in the long run that division of labor is likely to be? After all, if a CBDC is stolen or subject to fraud, or a bank holding CBDC falls over, or indeed a central bank decides to pay a different rate of interest on CBDCs, how durable is that division of labor between the public sector and the private sector, if you like, in a CBDC likely to prove? What do you think, Jim?
Well, Dominic, as usual, you packed a lot into one question. Basically, most of the questions are of import, but let me start by saying these are my words, not necessarily those of the Federal Reserve System. I'm sure Will say the same. Well, first, I think there's a couple of key premises you have within that question. I do believe that we'll end up with a public-private partnership, as you described, probably banks as intermediaries, but also I believe there'll be non-banks as intermediaries as well. I think we have the opportunity to create a great innovative platform with the central bank digital currency and then innovation on top of it for client services, for fraud prevention, all sorts of things. And one area that I think we really need innovation in, by definition, non-banks, is in financial inclusion or the unbanked. And obviously that's different from country to country. In the US, even though we've got a very strong banking system, we still have 5 to 6% who are unbanked, and then another 12 to 15% that are underbanked, meaning that they go to check cashers and payday lenders, et cetera. So I really think this is an opportunity to fundamentally look differently at solving some problems. We have a saying in Boston, if you've been to Boston and seen our crazy streets, that's not paved cow paths, because when you pave cow paths, you get Boston streets. So in this case, I think cow paths are the current way we do things. Not that we throw them away, but there's ways to think differently about, say, financial inclusion, or even AML, KYC, other ways of doing that differently, because we're creating a new technology platform. And as far as interest rates, that's going to vary country to country as well, as far as whether you apply them or not to a CBDC. That's a very, very open question. And I don't think it's settled in most countries' minds as to whether interest rates are not on CBDC. So I'll stop there.
Thanks, Jim. I'd always wondered what the origin of Milk Street in Boston was. Now I know. Will, what's your view on how stable this boundary can be? And perhaps more importantly, have we now settled the issue? Are all CBDCs pretty much going to be a two-tier system?
I think certainly in the larger and more developed economies, they will need to be. The way that I tend to think about it is people sticking to the things that either only they can do or the things that they do best. So in terms of managing settlement risk or interbank risk and stuff like that, that's one of the sort of superpowers of central bank money. And that's a thing that people like me get up every day and think about and worry about and design systems for. When it comes to things like building wallets, building apps, creating user experience, which encompasses a lot of the things that Jim was talking about there, about inclusion and unbanked and underbanked communities and stuff like that. There are people who are much better placed to do that. Actually, that's a place where competition and innovation can really play its part. Much as I might like to develop wallets or apps, I don't think very many people would want to use an app that I had developed, because it's not really the thing that I do. So I think there's kind of quite a natural shape to that. In terms of how durable it is, I think we'll see it evolve. And I think that will be a lot of the story about central bank digital currency across the board. It will start as something and it will evolve into something else, exactly as payment systems have done in the past. So yeah, it's durable, but it's durable because it will be able to change.
Mm-hmm.
If I could add one to Will's, there's actually a key point I usually like to make on this kind of question is, whatever platform is built as the core engine, it has to be flexible enough to change. I've been asked, how do I measure success? And I say it's 50 years out. It's not 5 years out, because it will evolve in ways we haven't even thought about. So the flexibility to, if desired, to have direct accounts, not saying that's very likely, but if desired, a system has to be able to somehow be flexible enough to accommodate those evolutions.
Now we've had our first question, actually, which is relevant to what we're talking about here, from Andrea Tranquillini. It says, in the European Union, one would expect the Commission would rule to define a single EU framework, and the Euro system, the ECB, would implement it, as they did for T2 and T2S, a homogeneous framework. are they anywhere close to doing that in the light of what was said in the introduction? Isn't this a risk that a lack of a level playing field would hamper the introduction of a CBDC? So I suppose Andrea is asking whether there's a risk that the member states of the EU start to diverge in how they go about this. Do you have a view on that, Will?
So certainly the ECB announced, I think it was last week, the results of a set of experiments that they have done over the last few years and what they intend to do over the next couple of years. It's quite a high level announcement, but what it does is it talks very much to that framework, if you like, that might sit across the whole of the Eurozone. They seem to be taking a sort of best of breed approach and looking at different parts of what they already have for those experiments, possibly building on tips and things like that. So I think we will see something like that. It seems to be being driven by the ECB rather than the Commission.
Okay, I've got a question here from Greg Chu, but I'll come to that in a minute. I'd like to deal with something else first. And Ricardo, maybe you have a view on this. The other big issue which we worried about when we first started talking about CBDCs, that somehow they would strip the private commercial banks of their funding base. They don't have any funds, they wouldn't be able to lend, and so this would destabilize the entire financial system. Now, some ideas were put forward to fix that, such as the payment of lower interest rates on CBDCs, which Jim touched on a minute ago, sticking caps on how much CBDC individuals and companies can hold. They all seemed a bit clumsy and would interfere, of course, with the natural flow of payments and capital through the system. Do you think that risk of private banks being stripped of their funding is an issue which has now gone away, or is it still a showstopper?
I think to some of the points already made, and by the way, thank you for having me on the session. So it's going to be jurisdiction based. I think there's different motivations across some of the central banks that we're working with. The latest report from the BIS suggests that the two-tier model seems like the best approach for distribution of CBDCs, meaning that you try and maintain and preserve a lot of the kind of the ecosystem and the structure that you have today, including the services and the benefits that are offered across the various participants. So I think state by state, country by country, you'll probably see a difference there. If you consider what's happening in the more advanced countries, so the developed side, you imagine a two-tier system would be the most appropriate, meaning that CBDC may be issued by the central bank into the wholesale network, and the wholesale network may then reissue the CBDC perhaps as a stablecoin pegged to CBDC. So we are seeing that use case being explored, meaning that you do preserve kind of the credit services that the banks offer, as well as the services that they offer in terms of AML, KYC, and so on. So I don't think there's one answer for everyone. I think it's going to be case by case, but certainly what we see most of, probably an 80-20 rule, is that 80% of projects are looking to preserve and enhance the current configuration.
Simon, I'd like to bring you in on the question of privacy in a minute. But before we do, can I just clear up one thing with Will and Jim? I think you both mentioned the question of non-banks distributing CBDCs. Does that create particular issues if people don't have banking licenses, but they are running payments apps, their ability to hold CBDC in digital wallets, as opposed to accepting deposits? Does that worry you, Will? Does it present particular issues?
So I think we need to separate the names of entities and the functions of entities. So if somebody is taking deposits and creating credit, then they are a bank. If they walk like a bank and quack like a bank, they are a bank, and we regulate them as such. If they are a payment services provider, even if they're a big tech firm that has got into payment services provisions, they need the licenses to do that, and they'll be regulated as such. And I see this as in a similar frame. Certainly within the UK, we've already brought payment service providers in, if you like. They can hold accounts at the central bank, and they can participate directly in the payment system. but they have to meet the same regulatory criteria as the banks do. There isn't it's not a backdoor cheat path, if you like. And I see this being very, very similar. If people want to participate in this, they have to understand the risks, and they have to have frameworks and mitigations in place for those risks. The important thing then is to make sure we have the right regulatory framework that reflects how those companies are operating and what those risks are.
And does that include holding reserves at the central bank?
Well, if you need to, then yes, it does.
Right.
If that's a requirement to address some of the risks that we're in, then you would need to hold reserves. Like I say, there can't be a sort of regulatory arbitrage. If you're like, I'll redefine my bank as being a payment service provider or an app provider or a wallet provider, and find myself with a sort of like cheaper yet ultimately systemically higher risk way of doing something. It doesn't work like that. Like I say, if you walk like a duck and quack like a duck, you're a duck, and we will regulate you as such.
And I'll just add, it's a good time to point out that obviously things, as you said, Dominic, vary by jurisdictions. So in the States, I think there's still a lot of debate and discussion going on about how various actors could play roles here. Chair Powell announced a few weeks ago that we'll be doing a public consultation this summer to get into some of these questions, in addition to other non-CBDC questions. But I think the roles of non-banks and the regulatory treatments, et cetera, I think are still under discussion and debate in the States. Some of it is solved by the fact that they may just be called money transmitters and then have to comply with KYC, AML, et cetera. That's fairly consistent, straightforward, but I think some of this is still open because of the nature of a CBDC. It's not the same as starting up a payment system, because it's a liability of the central bank. It's not a liability of the person running that particular scheme. So it's different, but I think it's still evolving in the States.
Thanks. Now Simon, Jim has just raised the question of KYC, AML checks. Now, everybody involved in the payment system, not just banks, but non-banks and financial market infrastructures, payment systems, are all subject to these FATF recommendations on checking the identity of the beneficial owner. But if we took a pure blockchain-based approach to a CBDC, these things would just be tokens. They'd be entirely anonymous. And one of the points the BIS makes in its long essay in its 2021 annual report is that actually we're going to have to go for an account-based structure in which the beneficial owner of that account is actually known. Now, this seems to me to present a fundamental problem, in the sense that people would like their business to be private, their accounts to be private, but on the other hand, that's going to be very difficult with a CBDC. Is there some compromise here that makes it work? The BIS suggests using digital identities, which kind of anonymize your identity, as it were, absurdly, contradictorily.
I think the problem is a confusion of, to some extent, a confusion of thought, if you'll forgive the phrase. The easiest way of thinking about a CBDC is as a digital representation of a physical banknote. Now, the way physical banknotes work is the central bank creates them, it blasts them out into the world, and thereafter it knows nothing at all about where they are going. Now, if you were simply to suggest what we're going to do is enable anybody who wants to transact in central bank money in a situation where the central bank has no idea who those people are, that is not really an acceptable outcome. Now, as soon as you've established that, then I'm afraid the central bank doesn't get to create the instruments and then step back. The central bank is involved, whether it likes it or not, in some process of ensuring that the instruments that it has been created are not actually being used for the purpose of money laundering, terrorist finance, or whatever it may be. Now, I think as soon as you've accepted that, one of the things you've had to accept is that we're not talking about a classical crypto token here. We're talking about a crypto token which can only circulate within a confined group. Now, it seems to me to be entirely plausible that what's actually going to happen here is that these things will end up as being very little more than a sort of crypto development of RTGS systems, because the easiest way to keep this tight is to say we'll only allow people who have full AML systems to come anywhere near these instruments. Now, if you create a CBDC whose sole usefulness is as an interbank settlement token, then there is a slight mons laborabit feel about that. It seems like a very long way around a relatively short point. But all the alternatives, if we're going to allow corporates, individuals, whatever, to handle these instruments, and the central bank has some degree of reassurance that that they're not being used for money laundering, then the central bank is going to have to set the boundaries of that system and to some extent determine what happens within it. So I'm inclined to suspect that this, if nothing else, indicates that your initial question, can we solve this with a simple wholesale retail split? The answer to that one is no. But just going on specifically to the privacy point, there is something terribly important here, which is, it's one of these points which is so big that people tend to ignore it. And it's this: if I instruct my bank to make a payment to your bank for your benefit, current law says I must specify your identity. I must specify who you are. In other words, I must tell my bank who you are. My bank has no business knowing that. It has no contract with you. It has absolutely no authority to hold your personal data. And I have no authority to give the bank the power to hold your personal data. So the current four parties, I mean, this is kind of dealt with within the existing banking system by pretending the problem doesn't exist. But it becomes a very, very sharp problem indeed when you go outside a closed system and start thinking about payments between four unconnected entities. So this sort of toxic triangle, if you like, between money laundering, privacy, and anonymous transactions on ledgers throws up some really almost unanswerable questions, and those will drive the shape of the system. But the shape of the system will be more complicated than we think, precisely in order to accommodate that little knot of issues.
You don't believe that digital identities are the solution to the unanswerable conundrum?
It becomes the problem that digital identities would be fine if it were completely impossible to access the internet anywhere in the world without a digital identity. I struggle with that.
Dominic, if I could add just one point here. I think this is an area where new technology may help and solve some inherent conflicts in policy choices, specifically privacy versus sanctions and anti-money laundering, et cetera. Are there ways to mask identities in a way that as few entities as necessary know who that identity is? You can think of cases, and I don't want to get too technical, but there are technologies called zero knowledge proofs and other cryptographies, which will allow you to examine data without actually seeing the data and only get access to the data if certain conditions exist, like it's a bad guy. Otherwise, you don't see the data. Or directory structures where you can mask the ultimate identity of someone only known to the directory owners, if you will. So I do think there's, and that's why in the Boston Fed is working with MIT on some of our research to try to give us access to some of the latest thinking in cryptography, privacy, et cetera. So I think there's a lot of work being done. Bank of Canada is doing good work in privacy, et cetera. So I think here's an opportunity to, as I said, not pave the cow path and potentially give policymakers better choices.
Just to extend, no,
go ahead.
Sorry, well, just real quick, just to extend that point, because you do see zero knowledge proofs and new technologies that are emerging, Simon, that may be able to kind of unknot that triangle you mentioned. Zero knowledge proofs is one of them. Secure enclaves is another technology that's being used for secure identities. It's a little bit like putting all this data into a safe deposit lock it up, and you can kind of ask questions of it, but you never know exactly what's in there. The other thing is, aside from the technology, I wonder if there's also other choices that we can make more on the design side, and we have these things today where transactions at low level, low value can be anonymous. I can have my tokens on my phone, I can bump them to your phone, Simon, it can go over Bluetooth, and there's no trace other than a token moved from one device to another. We had to connect on Bluetooth, but there's no trace of the connection, and now I have a token sitting on my phone, and that can happen at low value, low volume. So I think there's the technology today, I think, allows us to think about these things in a slightly different way, that we may be able to overcome some of the challenges that we have.
So to pick up that point, I think that the technology is only one half of the picture, and for sure, innovations like zero knowledge proofs and the like actually take you into a new place with cryptography. And it's just come up in one of the questions as well. The other half of it is trust. Now, I would say among a group of people like us, and probably most of the people who are watching this, have a reasonable understanding of cryptography or ZKPs, or at least trust that the mathematicians and cryptographers devised them did so in good faith and have done something. For people who don't understand those technologies and are not necessarily going to take our word for it, how do they build trust in these kinds of systems? I think being able to say, hey, we've got this incredibly strong cryptography will win over a proportion of the public, but there will be a proportion of people who are still skeptical. And I think as we start to roll out CBDC, it will be inevitable that people will start to ask the questions, picking up on something that Simon said, problems that perhaps we've been ignoring or pretending weren't there will actually come up to the fore. And it's going to be quite an interesting and bumpy ride.
We've had an observation from a member of the audience, Pasi Savannah, who says digital identity is also a question of whether you can trust the issuer of an identity. The issuer is the same as the person who issued the passport, including biometrics. You may trust them, but only a fraction of issuers actually meet this requirement at the moment, which prompts a thought in my mind. It's not just about the central bank impinging on your privacy. Also, there is a risk here, and the BIS alludes to this, of the FANGs, as it were, large social media organizations getting into the payments business. And you've kind of seen this in China already with WeChat and Alipay. You can't be confident that the Chinese government isn't looking at what's going on with your payments there at all. And variants of this problem could arise here if Facebook, and as they are, and Amazon and Microsoft and others start to get into this space. Now, the solution that's been put forward to this is that we all become owners of our own data. We become sovereign, the word is sometimes used, and so we decide who gets to see what we have, and then if we decide to buy a payment service from Facebook, we can consent to do that, and our digital identities, I guess, would work like that, provided we could trust them. Now, is that consistent? Simon, maybe you have a view on this. Is that consistent with us being owners of our data? Is that consistent with a CBDC working effectively, bearing in mind your triangle of difficulty?
No is the short answer. I mean, just to sort of wrap up the previous point, if you're anything to do with money laundering in a modern bank, you have two entirely separate tasks which are almost completely unconnected with each other. One of them is preventing the bank from being involved in money laundering. The other is compliance with money laundering legislation. The problems that we face here are much more to do with money laundering legislation than they are with actually preventing money laundering. Mm-hmm. But then going on to the privacy point, the whole the whole identity digital sovereignty thing strikes me as it's one of these lovely ideas that was coined by somebody who didn't have too much experience of reality. What we know about people's express preference in looking at their actual usage of the internet is that they will consent to absolutely anything more or less immediately. in order to facilitate the use of websites, or indeed for any bunch of other reasons. And I have an awful feeling that the result of an initiative like that would end up being nothing more than yet another one of those irritating checkboxes that everybody checks without reading in order to get on with what they were doing. Maybe a somewhat cynical view, but I think it chimes with reality.
Okay, well, I'd like to move on to cross-border payments. Before we do, I'd just like to get clear with you, Simon. Greg Chu asked you specifically a question. He says you've made some excellent points. How do you see the problem you pose around knowing the identity of transferee being overcome? I've kind of heard you saying it's impossible to overcome. Is that the right answer to Greg Chu?
Well, I mean, there's some wonderful guidance from the European data controller, data authority, basically saying, well, I think we can all ignore the problem on the basis that people can always be deemed to consent to receive money, which is a lovely idea in theory. I'm not totally convinced that it works in practice. But I mean, the trouble is, this would be a very easy problem to solve if we were to forget about broad usage and go to a sort of walled garden model, where we're saying everybody who participates in this can do whatever they like because they've been pre-vetted and everything in the garden is lovely. That solves the problem, but that's absolutely not what we're trying to design here. But it is, I think, at least possible that the existence of the privacy and money laundering constraints may eventually drive us to a walled garden model. But at the moment, I don't think that's what anybody wants.
Mm-hmm. Okay, could we move on to cross-border payments, because this is another area the BIS has been looking at. They published a paper in which they talk very explicitly about CBDCs, in effect, multiple domestic CBDCs becoming interoperable across borders, and they put forward these three approaches to it. It could be just compatible systems, or it could be interlinked systems, or it could be a single system hosting multiple CBDCs. And then this is actually being tested. This so-called MCBDC system is being tested by China, Hong Kong, Thailand, and the United Arab Emirates. Now, maybe Ricardo, we could start with you on this question. CBDCs are all being developed at the national level, the local level at the moment. And in fact, in another paper, the BIS says only 11 of those projects, there's like 50 of them, are even looking at cross-border components. So there's a chance here to kind of fix the fact that cross-border payments are very expensive, very opaque. Correspondent banks are getting out of the business. There's a real problem to be addressed there. And you're creating this new form of money, this new technology, which could solve that problem. But it's not really being thought about that hard, except by the BIS. Do you, in your work, do the central banks you talk to fretting about cross-border payments, and they see this as a way of solving that problem, bringing more countries and companies into the world trade system?
Yeah, so that's, I mean, they present some really interesting models there. Those models are being tested by Project Dunbar, as you guys may know, by the Bank of International Settlements hub in Singapore. You know, so the hypothesis is it one network to rule them all? Seems unlikely, but hey, let's go ahead and look at what that scenario might look like and what kind of interoperability measures we might need to put in place. Things like identity, of course, being critical. In this case, a single network, you'd imagine, a little bit to Simon's point, you know, a closed wall kind of, if everyone's in the same network, you've got one identity issuer. If you trust the issuer, well, then you can trust everyone that's in the network, right? So that seems like an easy option, but somewhat unrealistic. The other option being kind of a network of network architectures, but on the same technology. And to be fair, guys, I think, you know, the interoperability is super complex. And, you know, on the technology side, we've been grappling with, you know, a crawl, walk, run approach, meaning, hey, let's try and figure out how we interoperate just on our own technologies. You know, so this is, you know, a private Ethereum network talking to a private Ethereum network, or a private Corda network talking to another private Corda network. Even that's hard, you know, because you've got different identity issuers on, you know, on either side, and you've got obviously different notaries and different consensus models, etc. But I think, you know, I think those models are useful in order to try and at least grapple with some of the most important aspects of interoperability. And we see a lot of interoperability solutions out there today in the form of bridges. And you mentioned the CBDC bridge between the Bank of Thailand, Hong Kong, the UAE, and the PBOC. And those bridges are useful to some degree. You know, it's a little bit like building a footpath, you know, between kind of a very rocky side of one space and a very sandy side on the other space. And so you build a bridge that's appropriate to just cross that particular area, but then you might need to build a completely different bridge just further down because the land shifted and the consistency is different. And so you continuously build these very proprietary things. I think the goal is to build something that is more standardized and to build a protocol that allows interoperability to be possible regardless of the infrastructure that you build, regardless of whether it's one single network, multiple networks on one technology, or a network of network architectures on whatever technology you want, which seems to me like the model that we should really be exploring so that we're not constraining individual sovereign countries into saying, hey, you have to build on this kind of a thing. Everyone needs to use this database, else it won't work, right? I don't think that's appropriate. So we've spent years, the last 3 years, working on this particular problem. You know, in the next few weeks, you'll see a little bit more work coming out from our side anyway, around a protocol that at least starts to address kind of an interoperability protocol that is more standardized and generic. So
I think it's worth adding here too, though. I'm sorry.
Go ahead, Jim. It'd be good.
Yeah, I was going to say, I think that, you know, cross-border it's extremely complicated. It's not just a technology question. You know, we could have interconnected systems and still have to deal with FX issues and different laws and different privacy and different identity issues. And then the money, unless it's a straight remittance, it's going cross-border for some business reason, which means it's probably connected to some trade finance deal or major purchase. So there are other systems. So I like to think of it as, I think Ricardo used the term, it's a system of systems. So it's not even just one complicated system, there's interconnections outside. So the BIS roadmap for looking at cross-border, I think has 16 or 19 different areas of focus, only one of which is CBDC and technology. So there are many complicated areas, but I do think it's one of those proverbial cow paths that we should try to help resolve, since we're, you know, doing a one in a century change here.
Is it conceivable that central banks will get into the FX business? Will, I'm sure you have an opinion on this as well. Jim,
I'm glad you asked me, because this is a thing, and I think it's very tempting to think about this like it's email, and like, well, if we think about every payment network as an email system, why can't we just plug them all together and start sending sterling into dollars? And you're absolutely right. Fundamentally, when you're going from one currency to another, the values of currencies move against each other. And they move because of supply and demand, which means the movement of currency changes the exchange rate, which means somebody in that network is taking that risk. And they are going to want certainly to hedge against that risk and probably have some sort of reward for having taken that risk. You can call them a correspondent bank, you can call them an exchange house, you can call them what they like, but fundamentally that activity has to happen. So I think we then need to understand, well, how do you take the friction out of that? How do you take the friction out of the different fraud and anti-money laundering law that you'll have on each side of that? Now, part of that is to do with harmonization of laws. A lot of that's to do with the harmonization of data. You know, at the moment, we're still operating on sets of data formats that were designed when every byte of data you sent was expensive. So you squashed it all down. We now don't have that constraint, but we're still catching up. ISO 20022 takes us some of the way, but not all of the way, to actually having the information so that people can start to do those checks more quickly and take those frictions out. But it's not just about connecting computer systems together.
Can I just ask you, because the Bank of England has done something very interesting here with Finality, opening this omnibus account, which is a kind of private sector way of solving this cross-border payment problem. another initiative in the field is been launched by Baton, where they do these bilateral pre-funded settlements in different currency pairs. Now, these are stablecoin based initiatives, and stablecoins arose simply because we didn't have central bank money available on chain, as it were. So what's the future of initiatives like that? Are they going to be part of the ecosystem going forward, or are they like to be killed off once every major economy has a CBDC? Will, could you just address that? What you're thinking is behind the initiative with finality would be good.
Okay, so yeah, I mean, finality and the omnibus account is a way of starting to get into that, effectively, that tokens that are backed with central bank money. And that's what they are. It's a closed system, and the members of it are regulated entities. So it's not so very far away from the current payment system that it's you can think about within the current regulatory framework. Do I think they'll be killed off? I don't think so. I think if you look at the value that services like the ones you've mentioned, and there are other ones out there, of course, are looking to add, it's not just central bank money settlement. There's functionality and the removal of frictions within probably quite specific asset markets that they're looking to address. And I think if they're doing that, and they're doing that effectively, then the chances of something being superseded by something more general seem less likely.
Jim, yeah, I've been interested in your views on this, because the whole, CBDCs grew out of the concern about Facebook and what was originally called Libra, now DM. Private sector currencies developing a kind of role which exceeded their brief, if you like.
If I could add one point, and this gets into the public-private partnership and the role of regulation, especially with the Finality Network. That's a perfect example of something we started doing work on a couple of years back called the supervisory node. So you can think of the Finality Network as a closed network, but what if the regulator had a node on that network and was able to monitor traffic for systemic risk, for safety soundness of the institutions? There's a lot of, and we are talking to Finality about that concept, there are a lot of opportunities to allow the private sector to innovate and still ensure the safety, soundness, and financial stability or systemic risk that central banks care about. So I think this is an area where technology may allow some of the best things to happen in tandem. And that's a great example of that particular effort.
Just to extend on my side, I think, not all stable coins are created equal. So I think if you've got a stable coin that's, backed by, high quality money, reserves, those things probably don't need to go away. But if you've got stable coins that are backed by other things, a basket of currencies that maybe are more volatile, or HQLA that aren't as kind of high quality, then perhaps there will be an impact when you have the introduction of, stable coins that are backed by reserves and CBDCs themselves. So hard to tell at this stage, but on the finality side, you'd expect that to Will's point, if it's in place, it's high quality, it's doing its job, the regulators are participants within those networks. Why would you change that?
Now, it seems to me from everything we've discussed, we're actually, the central banks are putting quite a lot of trust in the private sector to be innovative in this area, to come up with the new products and services which reduce the cost of making domestic payments, let alone cross-border payments, but also provide a whole series of what we used to call overlay services on top of central bank initiatives. Now, I'm a bit cynical about what's happened in the payments sector myself. It seems to me that a small group of organizations have basically creamed off revenues of the banks and made themselves very rich in the process without actually fundamentally changing the way in which payments work. Now, Simon, perhaps you have a view on this. Can CBDCs actually lead to meaningful structural change in how companies and households make payments, more meaningful than we've seen so far from the type of innovations we've enjoyed?
Well, my answer to that would be a fairly straightforward no.
I start calling you Dr. No. Yours.
I mean, I think CBDCs have a significant use for commercial transactions, particularly cross-border commercial transactions amongst corporates. As far as retail users are concerned, this is still a solution in search of a problem. And the reason for saying that is that most commercial users of money, most retail users of money, i.e. us, are completely risk insensitive to the risk exposures we currently face to our commercial banks. And if the truth be told, completely indifferent 99.9% of the time to the question of whether our transactions are settled in microseconds or days. So I think if you look at what is currently offered to retail users in terms of the payment services they currently have access to, in order to conclude that CBDCs will make a major difference to that segment of the market, you have to be able to point to a significant advantage that those users would derive over and above the service that they currently have. At the moment, I can't see what that might be. I mean, I take the point you should never underestimate the private sector's capability to innovate. And there might be, the equivalent of a web browser around the corner, and I'm just too foolish to think about it. But at the moment, I would suggest there is no such product and no such idea out there.
This is quite
a good point. I think I add to Simon's.
Yeah, go ahead, Jim.
I do think the innovation. I mean, who knew I have 3 iPads. Who knew I needed 3 iPads or 2 iPhones? Yep. So I do think it's an area ripe for innovation. And as we know, it's not necessarily what a person wants because they know they've got a problem to fix. There are frictions out there. Yep. There are things that, the cow pass, things that can be done better. But also look at this is a two-sided market. Look at the receiver of the funds. Would your landlord want to get CBDC or a 2-day-old 3-party check? Would they want to be, would stores want to take CBDC at 0 cost or little cost, or would they want to take a credit card or something else? I'm not saying that these are all the right answers, but I do think there's motivations and innovation that has the potential. And it does get into design, and it came up earlier. If we limit the amount in a wallet to some de minimis amount because of bad guys, we're not going to get to a fully functioning and very innovative platform. So I do think we need to weigh all these. I just wouldn't dismiss the power of innovation and parties that have a motive that may be solved, that may not be the holder of the currency itself.
Seems a good point to raise at last the question Greg Chu asked a while back, which is why should a scalable, secure, compliant economic network in which assets can move from one account to another require the intermediation of batching and settlement? To refine my question, if the technology evolves to make unnecessary the 2-tier system, does this change the perspective of the panel? So he's asking, public sector does all this underlying infrastructure, private sector, which we've just been discussing, does all this innovation. What if we have a system where the technology has evolved such that that distinction, that division of labor between the two actually becomes meaningless? You're nodding furiously, Simon. And for once, you're saying yes. But maybe maybe you have a perspective on this.
Maybe it's an emphatic no.
I was about to steal Simon's thunder and say no. Yeah, what do I mean? The advantages of a 2-tier system go beyond batching. Is the point I make? I can absolutely see. In fact, we're already in a world where the technology would support, if you like, a tier 1 backbone that operates at the same speed as a user facing tier 2. We can see that in conventional payment systems, and we can see that in what some of the more modern platforms might look like. My point that I was talking about at the beginning, I think is more how I think it's about what the different actors in the system are there to do. Now, arguably, you could say once the backbone is operating at the same speed as the sort of the front end, does it become a single system? Well, maybe is the internet a single system? I don't know. But what I do see a distinction in is the different roles that people have and the different things that they are trying to do. And as a central bank, we will be worried about that systemic risk. We will be worried about financial stability, the impact on the financial system and all that stuff, so that the public can spend money without having to think about it, so people can make investments without having to worry about it. Likewise, people who are creating innovative products want to focus on their innovation. They don't want to be hamstrung by worrying about the stuff that I'm worrying about, if you see what I mean. So those tiers are as much about risk as they are about operation.
To be clear, Will, are you describing a system which not like the one we have today, where the private commercial banks net off payments against each other, batch them up, and send them to the RTGS to settle in central bank money? You're talking about skipping that stage eventually, is that right?
Or just updating the central bank ledger in real time. I mean, TIPS does that effectively. The NPA system, instant payment system in Australia, works like that. And yes, they're still two-tier. So I think that's what I have in mind with that when I'm saying actually some of this technology out there that's already showing that this is.
We're talking about real-time gross settlement for retail payments.
Yeah.
Yeah, that's what Boston's building right now with FedNow. You know, it's RTGS to work at tens of thousands of transactions per second. You know, with at scale with resilience. So it's not central bank money. It's still a two-tier system, but transactions are individually processed. So it's feasible and it's actually happening.
Yeah, it's doable.
Yeah. And you'll need the money in your account for that to work.
True, it's still commercial bank money. Yep, you still need money in the bank, as they say.
Yeah.
But
Dominic, can I just raise a quick point about that? One of my favourite little factoids. SS Great Britain makes the first powered crossing of the Atlantic in the 1830s. Cutty Sark, which is probably the fastest trader, is built in the 1870s. These technologies do not succeed each other, they overlap. And more to the point, the introduction of new technologies drives really serious technological innovation in the old technologies. So I think it's important to remember that for a very long time to come, even if we see CBDCs circulating, we will see them circulating in parallel with the existing payment systems, and they will place considerable pressure on the existing payment systems. And one possible outcome of all of this is that CBDCs are created, they do circulate, and they are eventually outcompeted by the old technology.
Well, Simon likes the cross Atlantic. I usually use ice harvesting refrigeration for my analogies. And there are plenty of analogies of technologies. And I always say, are you making a faster ice truck or a refrigerator? And so and there was a long overlap. It took 60 years for refrigerators to be ubiquitous in the States. And so these things, as you all know, take decades, no matter what happens. So
Greg has stayed with the discussion. He said, undeniably, any issuer of a currency should be a regulated bank, ideally within a leading regulatory jurisdiction. How might a central bank approach this opportunity to partner with a regulated bank to issue a commercial bank digital currency? That's an interesting question. Maybe you have a
well, Dominic, I'll take 1 second on that and go back to the history of the U.S. When in the late 19th century, we did have banks issuing paper currency. We had municipalities, we had cities, towns, and then there's a slight problem. They weren't trading at par. And once you get a currency that doesn't trade at par, or checks that don't trade at par, and so a person in Boston with a Chicago bank dollar may not get $1's worth of value from it. So I think that's the analogy. Not that that's a reason not to have private issuers, but to have only private issuers, I think, creates challenges in the trust in those instruments, the potential for fraud. And we have a perfect example in the States. I'm sure it's repeated in other countries as well. But
so in the United Kingdom, in Scotland, in Ireland, there are banks that issue their own banknotes, but to address that very problem of trading at par, for every note that they have in issue, they have to hold a Bank of England note. So that effectively the books are kept the same. So there is a model for thinking about this.
But those are still fairly closed, small systems when you think about it. CBDCs and other electronic money could be international and likely be international. So I think you'd have more chance for non-par when you're going cross borders or you're dealing with non-homogeneous users.
Just on that par point, one of the ideas that does float around from time to time is the notion of CBDCs carrying interest. And as you know, there's been a certain amount of fascination with the idea of them carrying negative interest. Now, it seems to me that in order to be usable as a payment medium in the form that you're talking about, a thing has to have constant value. In other words, it cannot carry interest, positive or negative. There's a very interesting sort of balancing act there as to, are you more interested in monetary policy or are you more interested in the provision of payment systems?
Now, we're down to our last 5 minutes, and I'd like to dispense at least with a final question from a member of our audience, from A. Patel. Can you offer thoughts on cross-border payments and how they will be implemented, integrated securely? Now, we did touch on this earlier. I don't know whether you feel there's anything to add to that. Ricardo, you said you'd been looking at this, done a lot of work on this. You're about to publish something quite soon. Is that right?
Yeah, but I think, to Jim's point and Will as well, there's so many layers that you need to address cross-border payments on. And you'd argue that very soon, the technology is the least concern. Mm-hmm. Things like FX, I mean, that was mentioned earlier, until we solve for that, that's a very big conversation, a very big debate. How do we solve for FX? Who's gonna manage that? Do we just use old systems with oracles in these networks and just use kind of current FX markets? Do we invent new ones like we're seeing in kind of the public space? So I mean, that's a very long debate. I think we touched on some of the key things, but technically, I think we'll get there in the next 12 to 24 months. You'll start to see a little bit more around interoperability and true interoperability. Certainly, that's our feeling. But then I think there's issues that will take a hell of a lot longer than the next 12 months to solve.
Okay, well, A. Patel can look forward to your paper coming out soon. Right, I think we must stop in about 4 minutes' time, but I'd like to just close out with my final question, which is really about whether we actually need CBDCs. As we've talked about this afternoon, we're already getting instant payment. We have it in many markets, and even the United States is moving in that direction now. We're coming close to retail, real-time gross settlement as well. We've got open banking, open data initiatives in most of the English-speaking countries at least, and that's opening up competition for payment services and bank accounts and the rest of it. From a lot of what I've heard this afternoon, the CBDC isn't going to represent a huge advance on our present system of giving reserve banks access to central bank money. We've even seen that you can settle security tokens very satisfactorily using non-central bank, non-CBDC solutions. So the argument that's going to lead to a takeoff in security tokenization market seems somewhat exaggerated as well. The pandemic's taught us we can do helicopter money already. If we need to do it, we can even charge negative interest rates. We have those today. So what are CBDCs actually going to do for us? Now, Ricardo, I know you're under a bit of time pressure, so why don't you give us your thoughts on that first?
Yeah, I mean, one of the key innovations that we keep calling out is this notion of programmability. So the ability to add kind of rules to your money. Now that's a double-edged sword, to be honest, or a double-edged kind of an opportunity, but also a concern if you consider that programmability might be useful maybe in the wholesale side, but then gets really tricky at the retail side. If you control the money, is it really a public good utility, and is it something that's free and open, accessible, anonymous, and private, etc. The other area is instant settlement, but we're starting to see instant settlement solutions, and we hear I liked what Simon suggested, that there's kind of obsessive innovation on old technology to catch up, and oftentimes you can get there with the old technology. So I think the jury's out, to be honest. I think we look at resilient systems, so distributed systems being a little bit more resilient than centralized systems, but we've been building resilience in central systems for years. So I mean, my view is that there's still more work to be done. I don't think we have the answer just yet.
So, Simon, would you like to be paid in a central bank digital currency that can't be spent on alcohol or tobacco? Do we need CBDCs more generally?
Possibly, but we have yet to invent the thing that we need them for.
I guess I'll add mine. First of all, if I was Sweden, I'd be thinking of a use case because paper currency is not in circulation. If I was a Caribbean island, I want it for efficiency. So there are different motivations for doing it. My personal view is we'll eventually get there. We'll eventually get the right technology, but that's just mine. I don't think that it's definitely not a decision made in the States at all about whether we're going to issue or not. But my job is to make sure that technologically we're ready and we understand what's possible. And just for the record, I'm not big on programmable money. I think money should be stored and moved very efficiently and with less friction. And innovation can go on top. Put your smart in a wallet, or put your smart at the register that looks for my digital identity that proves I'm 18 or 21 to buy a product. So I wouldn't put it in the money. I believe in relatively dumb money, put it that way.
I like that, dumb money. Will, a last word from you. Do we need CBDCs, or can we have a dumb CBDC?
I think we'll start with dumb CBDCs, and I think they will get smarter as we go. Similar to Jim, I mean, the official line from the Bank of England is we are minded to issue a digital currency, which is probably the most British thing ever, which means we're working very hard on it, but we've not taken the final decision to roll one out. I think it's very, very hard to see where those benefits are. I also think when you look at the current payment system, next time you're holding your debit card and typing the number into a web browser, you need to ask yourself if that's the solution you would invent to that problem. And I think the answer is a clear no. I think we will look back on it 10 years hence and go, well, of course, in the same way that we look back on decimalisation. Does anyone want to go back and have pre-decimal currency? No, they didn't, but it still took 150 years for the UK to decide to decimalise. So, let's not be the guys who were sitting there going, well, really, 12 times table is not that bad.
Yeah. I can remember avoir du pas and all my times tables, yes, but
12 by 12s, absolutely.
Yeah.
Sadly, I think that's all we have time for. I'd like to thank our panelists, Will Lovell from the Bank of England, Jim Cunha from the Federal Reserve Bank of Boston, Simon Gleeson from Clifford Chance, and Ricardo Correia from our sponsors at R3. I'd like to thank the audience too, also for your questions and your comments. Some of them we are still there, and we will address those in due course and share them with our panelists. At Future of Finance, we are taking a summer break now. We'll return on Wednesday, the 8th of September, same time, sadly the same place, 1400 London time on Zoom. And in it, we'll be discussing another aspect of data, how data management is helping asset managers lift performance. We hope that many of you will be able to join us then. But for now, it's goodbye from the five of us.